Alrighty, welcome. This is Business 130 Macro. This is week 4. So this is the second week that we are having 2 chapters per week. Hopefully you are keeping up with the assignments. Make sure you look at Blackboard and see what's due every week. I'll show you. This is Blackboard. When you go to coursework and you go down, you should go down to your week, which is week 4 this time. Should be available to see that, and there's a list of what's due, so all the stuff you need to read and review, and then all the assignments and the discussion board, and then you need to, the rest is what is the course objective, what are we talking about this week. This week we're talking about the gross domestic product, unemployment, and inflation, which are very important topics. And if you look at the assignments folder is down here. You have to complete it by the end of this week, and then you can try to do it by that time. Then you go to material and resources, actually before that, and that's where you have access to the 2 chapters. So you can read the chapters, and then you have access to the PDFs of the 2 chapters. So you read the chapter, then you can look at the PDF because it's kind of a summarized version of the chapters. And now we'll look briefly at some of the 2 PDFs. So we'll talk about briefly of what's going on this week. Let me shift now to PDFs, and the PDF for chapter 5. You can see here that in chapter 5, this is measuring the economy activity, GDP and unemployment. And these are important chapters. They're important because that's how everything else is based on. So this chapter we do GDP and unemployment. Next chapter we do inflation. So before you do any policy and make any decisions, you need to have a good measure of those things. So how is the economy doing in terms of production? How is the economy doing in terms of employment? And how is the economy doing in terms of price changes? Okay, so for a gross domestic product, which is the most common measure of how an economy is doing, there's a definition for that, which is the market value of the final goods and services produced in a country in a given period of time. Seems pretty straightforward, and what it means is you go out, you look at the value of everything that's total value everything that's produced in a country in, say, in 1 year. Usually is 1 year or 3 months, so a quarter, and you measure total final goods and services. The reason why you want to measure total final goods and services consumption is because you don't want to double count the intermediate factors. Okay, so the final price of bread will have in itself, inside it, the price, also the initial value of the flour consumed, or the yeast consumed, of the labor of the baker. Okay, so you don't count the flour sold from the farmer to the miller to make bread and then to the baker, but you only count the bread because they all add value, and in the end the final goods and services are what really matter for people, because that's what we want for consumption. Okay, and that's what matters, right? And so the chapter talks about how is that done. There are examples, there are little problems, and then it talks about how you account when quantity changes, when prices changes. So you can think, that you can have the same situation when you have the same number of goods produced year after year, but if the price of those goods goes up, it looks like the production goes up, but it's not true if you have the same amount or less goods. And so you need to adjust for price changes. There is a methodology to do that, and if you have questions, send me an email and I'll explain it more in detail. But the book, I think, does a pretty good job at explaining that. And so there are examples, and they talk about the GDP of the US, how that's changed, and I think the slides are up to 2016. Then there are the different components. So when you talk about gross domestic product, you can see that some consumption will be final consumption, some consumption will be for investment, DI here, meaning a company purchasing a machine to make something else. Some will be government spending, and some will be exports and imports. So exports are a good thing. We make something that other countries buy. Imports are a bad thing, relatively. It means some other countries make something and we buy it. Okay, so all this needs to be considered when you calculate the total amount produced and consumed in a country for the year. Okay, so that's for the gross domestic product. And then you go into, sorry, I'm sliding down here, but you can see, so there's a lot of consideration: underground economy, changing quality, quality of life. Do you measure everything? Welfare, how the GDP really measure what's good and what's not good, all this, right? But the next part of the chapter talks about unemployment. And unemployment is relatively straightforward. What it talks about, what it measures, it tries to measure how many people that are willing to work do not have a job. Okay, that's the unemployment rate. So if you look at this total population, some people cannot work by law. If you're 5 years old, you don't work. If you're retired, there are certain categories of people that don't work. And so these are excluded for the labor force. The labor force are the people that are able and willing to work. You can be out of the labor force for your own choice. Maybe you're a full-time student and you're looking for a job. Maybe you're wealthy, independently wealthy, you're looking for a job. Maybe you have a disability and you cannot work. That could be a whole bunch of reasons why you're on the labor force. But of the people 16 and older that can work, some will be employed, some will be unemployed. And unemployed means I want to work, I cannot find a job. And so you simply calculate a percentage of people, of all the potential workers willing to work that don't have a job. That's the unemployment rate. Okay, and then there are nice charts how there are specifics about that and how they vary over time, but this is a chart of unemployment rate for the United States over time. This goes up to 2016, and if this continued, you would see for 2020 also a jump up, because that's for COVID, and then it's down again, and now at historic lows. Now is on the 3 point less than 4%. So now we are down here in 2024. But this is basically how this chapter works. You have to do all the problems. It's important to understand, because when I talk about unemployment, when I talk about GDP, when I talk economic growth, we need to know what we're talking about. Like, we need to establish a measure that is comparable from year to year. Okay, so this is what we do for chapter 5. Chapter 6 is chapter about inflation. And there is one full chapter about that, because there's a lot into it. Okay, so basically you want to see what's the price level doing? How much can my money buy? And so the way this thing called the consumer price index, there are other measures. There is the producer price index, the inflation, the index for exports and imports, but we mostly focus on consumers. For this is the important one. And so you want to know how much each dollar buys. What's the purchasing power? How does it change over time? Can I afford the same lifestyle with the same amount of money? Okay, and that's hard to do because there are billions and billions of items produced. So you cannot really calculate every time, every month, the price of everything. So what you do a survey. So what the government does is a survey comes up what is called a basket of goods. And the basket of goods is the basket of goods that a typical family would consume in a specific period of time, right? You will have some housing, you will have some foods and some food, you'll have some clothing, you'll have some travel, you'll have some medical expenses, you'll have some part of a car, computer, whatever, right? And so you look at what the typical consumption is, you measure the cost of this consumption. So you actually go out and measure the price of gasoline, the price of milk, the price of rent, whatever, right? And then you calculate how much this typical consumption, how much does it cost over time to have the same lifestyle? Okay, now you can already see what the problems are there, because things change, right? In this calculation, 30 years ago, 40 years ago, 50 years ago, there would have been a typewriter, while now there is a computer. And so how do you account for technological changes and new things come up? There were no smartphones 20 years ago. And so most people had, 30 years ago, most people had a landline, and there was a specific cost for that. Now the costs are different. There is internet, there's all changes. Then there are qualitative changes. So you can have still a car, but the car today is not the car of the 1950s or the 1960s. The quality is way better. So how do you account for that? The price might have gone up, but some of the increase in price might have been captured, needs to be captured by the changing quality of the item, not necessarily just by the price of the item. Okay, so all these considerations are very important when you calculate inflation, but it's important to come up with a number that is agreed by most people. And actually the way CPI, this consumer price index, is calculated is agreed by most people. and it's important to understand where it comes from and how it can be used. So when you do historical comparisons, and you can say, well, the wage in 1950, the average wage was, I don't know, $5, $3 an hour, and now it's $20 an hour. How do the two compare? Like you can say, oh, it's much more, but it's not necessarily true. What the question you want to ask is how much stuff, what lifestyle could you have with $3 an hour 50 years ago and with $20 an hour now? I'm making up numbers. I don't know exactly what they were, but you get the point, right? So what could you afford? How much the quality of life has changed with this more money? Is that because prices have gone up, or is that because we are rich, we can buy more stuff, right? And so you need to, what is called adjusting for inflation. And they'll talk about how this is done, but you need to understand the process, because when you compare things across time, you need to account for price changes. And this type of index is very important because it's used by the government and private entities in many ways. So for example, if you know somebody or grandparents that are on Social Security, they get the check from the government. That's adjusted every year based to inflation. It's called cost of living adjustment. And a lot of payments are like that. You need to account for that. Tax brackets are adjusted for that. So, if you think about it, inflation, prices go up, wages go up. And if you understand how the income tax system works, you will have an increase in taxes, not because you make more money for real, but just nominally. So the actual number is called nominal, the number that you measure, and then the one adjusted for inflation is called real. And so you need to understand the difference between nominal and real. And the book does a fair job in explaining all this. In any case, these are the two chapters. They're important chapters because they're the base for everything that we do after. All the policies that we discuss are based on these measurements. And the policymakers will decide, oh, the economy is not growing fast enough, or unemployment is too high, or inflation is too high. What are the policies that can be done to improve the situation, to have faster economic growth, to lower unemployment, or to decrease price growth like now? Like now we're at a point where inflation last year was much higher. This year has been a bit more under control, but it's still under 3-4%, which is way above what the target is of 1 to 2%. And over time that accumulates a lot. So it's important to understand how this works. Okay, so these are the topics of the chapter. Make sure you understand that. Review the chapter. Email me if you have any questions. I'm still adjusting something, always adjusting something on Blackboard. So please feel free to contact me if you have any questions, and I'll try to help as much as I can. Thank you very much, and I'll see you soon. Bye.